right, everyone, get ready because today we are diving deep, and I mean deep, into JPMorgan Chase's Q3 2024 earnings. We've got the reports, we've got Jamie Dimon's comments, we've got it all right here. And we are going to break it down, cut through all that financial jargon, and figure out what these numbers really mean, especially for you.
Yeah, no doubt this is a big one. The Fed just made that interest rate cut, remember? Everyone's kind of nervous, right? So all eyes are on JPMorgan Chase right now. Everyone wants to know what they're thinking, where they think the economy's headed.
Makes sense. I mean, they're the biggest bank in the U.S., right? So when they even flinch, everyone on Wall Street pays attention. Speaking of big moves, let's talk about this net income, $12.9 billion. That's huge. But it's actually down 2% from last year. Got to be causing some waves, right? What are you hearing?
Oh, absolutely. Even a little dip like that gets people talking, gets them worried. Is this just a blip, just one weird quarter, or is this the start of something bigger, something bad? Remember, everyone's trying to predict the future, right?
Yeah.
So even a small change like this can send shockwaves through the market.
Okay, so maybe not time to hit the panic button just yet, but definitely something to watch carefully, especially since their revenue actually went up this quarter 6% to $43.3 billion. So they're bringing in more money overall, but making a little less profit. How does that work?
Well, that's the million-dollar question, isn't it? And that's where things get really interesting. Got to dig a little deeper, look at the different parts of their business. It's not just about the total amount they're making. It's about where it's coming from and where it's shrinking.
Let's do it.
Think of it like this. JPMorgan Chase makes money in basically two ways. You've got, on the one hand, their net interest income, which is basically the profit they make from lending money and earning interest, like a traditional bank.
Okay, yeah, that makes sense. So what's the other side of the coin?
So that's their non-interest revenue, which is a pretty broad category, actually. It includes all sorts of things like fees they get from services, investment banking, wealth management, you name it, and then the profits they make from their trading activities.
Right, like playing the markets. Okay, so we've got the lending side and the fee and trading side. Which one's dragging them down?
Well, it's their net interest income. That's the problem. If you don't count the part that comes from the markets, which can go up and down like crazy, it only went up 1% this quarter.
1%. That's it. Why so small?
Well, one of the main culprits is something called shrinking deposit margins. Basically, it's getting harder to make money from the difference between what they earn on loans and what they pay out on deposits. When the Fed cuts rates, like they just did, that spread starts to narrow, and it can really squeeze the banks.
Ah, so that's where the Fed's move really comes into play. It's like a ripple effect, right? The Fed sneezes and JPMorgan Chase catches a cold.
Exactly. And JPMorgan Chase, like all these other banks, they've got to walk this tightrope. They lower deposit rates too much. They risk losing customers who can find a better return elsewhere. Right? But then they need to stay competitive on loan rates, too, or nobody borrows from them. It's a tough balancing act for sure.
And that balancing act, I'm guessing it's about to get even trickier with all the economic uncertainty Dimon keeps talking about. Speaking of which, he did not hold back on the Fed, did he?
He did not. And everyone knows Jamie Dimon doesn't just shoot from the hip. When he talks about excessive regulation stifling growth, people listen.
Yeah, you can practically hear the whole financial world going quiet when he starts talking like that. It's like he's trying to walk this fine line, On the one hand, he's saying, look, we need some oversight here, especially after 2008, right? But then he's also worried that too much regulation is going to choke the economy.
Exactly. Trying to find that sweet spot, enough regulation to keep things stable, but not so much that it kills innovation and growth.
Right. And what about that comment about not buying a private label credit card company? Seemed like a pretty clear signal to me.
Oh, absolutely. He's basically saying, hold my beer, folks. Things are about to get bumpy.
He'd rather batten down the hatches and ride out the storm than make any big risky moves right now.
Exactly. He's all about caution right now, all about financial stability.
Yeah.
And you know what else points to that? That mountain of cash they're sitting on.
Oh, yeah, that excess capital he keeps mentioning. Didn't they say it's like, what, over $1.5 trillion in cash and securities they've just got lying around?
Yeah, it's a staggering amount of money.
It's like they're building a giant Scrooge McDuck vault while the rest of us are out here dealing with inflation.
Well, it's certainly got everyone talking. Why would you sit on that much cash when you could be investing it, expanding, making headlines?
Right, that's what I want to know. There's got to be a bigger story there. It's almost like Diamond sees something on the horizon, something the rest of us are missing.
Well, to figure that out, we need to look beyond the balance sheet, don't we? We need to get inside Jamie Dimon's head.
Let's do it.
Yeah.
All right, so We've got this picture of JPMorgan Chase. They're being super strategic with their cash. Jamie Dimon's dropping these cryptic warnings left and right. What's the takeaway for our listeners? What should we be watching for in the coming months?
The key takeaway here is that JP Morgan Chase, their actions, it's like a signal, right? And it's not just about their balance sheet. What they do, especially with that excess capital that Diamond keeps talking about it, could tell us what's coming for the entire market.
Okay, so they're like a bellwether. What they do now, the rest of the market follows.
In a way, yeah. And Diamond, he's not just some CEO. People respect him. They hang on his every word. So if he's being this cautious, well, it makes you think, doesn't it?
It does. But does that mean we should all be stashing cash under the mattress like he is?
Well, let's not get ahead of ourselves, haha. But there are some parallels here, for sure. Just like Diamond is prioritizing stability and flexibility for JP Morgan Chase. Right.
Hmm.
You might want to think about doing the same thing with your own investments.
So you're talking about diversifying, maybe shifting some assets into more conservative stuff.
Exactly. It's not about panicking. It's about being prepared. Diamond's clearly concerned about where things are headed.
And he's probably got a better view than most of us, right?
Exactly. But it's not about running for the hills. It's about having a plan, being ready to adapt.
Gotcha. But here's a question. If they're so worried about the future, why did they buy back all that stock this quarter? $6 billion worth, wasn't it?
Ah, good point.
Yeah.
That's what makes this whole thing so interesting, right? Remember that $1.5 trillion in cash they've got? That buyback, it's a drop in the bucket.
Huh?
They could buy back way more, but they're choosing not to.
So it's a signal, what they're not doing?
Exactly. They clearly think their stock is a good investment, but they're not going all in. They're keeping their options open, just in case.
Wow, this is fascinating stuff. We've gone way beyond just the numbers here. Any final words of wisdom for our listeners before we wrap up? What's the one thing you want them to remember?
I'd say keep your eye on JP Morgan Chase, what they do in the next few months, how they handle all that cash. It's going to tell us a lot.
Great advice. Thanks for joining us today. It's been a pleasure picking your brain.
Anytime. Always happy to talk shop.
That's it for this deep dive, everyone. Thanks for listening, and we'll catch you next time.